Adam, are you gonna come on during the thing at all? Because if you do, then I probably need to just say that you're in the background at some point.
Um, I don't know.
All right, welcome to AMC and ADD, where we buy, hold, and screw the hedgy. Today I have True Demon on the show today. He has some amazing DD that he's going to help share and help us to answer some questions for a lot of his DD that he has to share with us. I think this is going to be an amazing hour to just kind of sit here and spend time with him, talking to him about who he is and what it is that he's found, and we'll just sit here and kind of watch the stock prices in the background as that's happening. Welcome to the show, True Demon.
Thanks. Glad to be here, man.
So tell us a little bit about yourself. How did you kind of come into the land of AMC, and what do you do for a living, and kind of summarize like who you are.
Yeah. So I actually am not. I'm very new to the financial markets, relatively speaking. My day job is as a penetration tester, which is all the innuendo and jokes aside. My job is to hack into companies' networks in order to test their security. So I'm more of a cybersecurity consultant, um, and that's what I do for a living. But I got into finance. Very recently. I played in the stock market with things like Acorns app and Robinhood 3 years ago, and started like seriously investing once I got some money together and I didn't want to just do savings only. Um, but after I got some pings on alerts for GameStop, I was like, wow, that's nuts. It's going up, like it's up 200%. That's a little crazy. So I started looking at it and I paid attention to what was going on with social media. I found out about Roy Kitty and Keith Gill, same guy, and just started like paying really close attention to what was going on with social media. And I'm like, oh my God, there's literally a movement. There's a meme movement to go and overthrow the stock market. And that just, I'm an anarchist at heart, and that just lit me up. So I got in onto that play and I did buy into GameStop on the backside of the squeeze after it like ran up to that insane 200. So it hit that dip and I threw some money into it and lost it almost immediately. So um, I
Was that date around the what date did you say that was?
so that was like January 28th. I literally came the day after the squeeze happened.
Same here.
Um,
That's the same exact day I got in. So you and I were on the exact same day. It was like
yeah,
I want
and
to say
I
it was
think that
325 when I bought in.
yeah. So like so many other people, I ended up turning into a bag holder with my first real foray. And the saddest part is that in the first year of the stock market that I was playing on Robinhood, I invested almost wholly into weed stocks, lost it all in the weed crash, and then I made all that money back with Tesla because they squeezed, and that was just pure luck because I love Tesla. And then I threw it all into GameStop and lost it again. It's such a depressing story, but it it had an interesting effect of getting me really invested emotionally into what was happening, and it became more important to me. So rather than sell, I stuck with it and I held on to my position. Um, and I started paying attention to the other meme stocks because I started looking at the other squeezes that were happening around it. And it brought to my attention stocks like Sens or Sensionics, and AMC and Bed Bath and Beyond, and like all these random stocks. It's just like, why are these doing so well? What is happening with all of these that they have in common?
Hmm.
And yeah, I dove into the rabbit hole head first, and I've been in this thing since January, just researching the hell out of it. Um, and I think I finally found my element when I got connected with Matt Cora's channel, um, sometime in early February, and yeah, that was that's what sold it. So of course I still do my day job. I split my time between breaking into companies' networks and telling them how to be more secure, and inevitably they don't listen to me, but I do it anyway because it's fun,
They
and
they always see
I
the
play
that
the stock market to make my real money.
they always see the dollar amount behind what it's going to take to cost them to save themselves, and as soon as they see those the price, they just kind of like, well, maybe there's other things we can do. So,
Oh yeah,
yeah, yeah. But that's actually
yeah.
really
I
interesting line of work, though. Trying to break into companies. How awesome is that?
I really do love it. It's truly my dream job. I didn't even know it was possible. I was a desktop analyst for years. I was doing network administration, and then suddenly I started playing around on old hacking forums that I used to hang out on again while I was trying to go to school for game design,
Wow.
and just didn't really know what I was doing with my life. I've done so many things. I was a soldier at one point. I've tried to do game design. I've been a HVAC technician doing heating and cooling, just all sorts of random jobs.
Hmm.
And while I was in that college, my fiance, now my girlfriend at the time, asked me like, "Why are you doing game design? You know that's an art degree, right? You spend all your time looking at hacking and trying to do that. Why don't you just do that for a living?" I was like, "Holy crap! Why aren't I doing this for a living?" So it's just it's like a duh moment, and I woke up to it, and it yeah, I got sold on that line of work almost instantly, and I figured out a way to break into it. It's a hard industry to break into, but when you finally get your mark, like when you get that first job as a pen tester or even just a security analyst, it's good work. I love doing it.
Yeah, and so for that reason, audience, just for those of you who watch, this is the reason why I'm protecting his. I'm giving him some anonymity here because of the fact that his line of work would probably really need to have that. All right, so I appreciate that. Awesome, thank you for telling about yourself and kind of like your past history and how you kind of found your way into AMC. I think a lot of us kind of fall into that same category. I myself, I've been trading. Uh, I started trading when I first went into the semiconductor industry, which is an industry I worked in my entire life. And so I made all those computer chips that you're working on. And essentially what happened was, of course, when I got into that industry, they had 401ks. So I started putting into 401ks in like 1998. Kind of moved into some trading there, whatnot, along the way. But I learned a lot of mistakes as I went, and there were probably 3 or 4 significant times in my life where I kind of moved away or repositioned myself away from the market because I got hammered so bad that I took a beating and just said, okay, I'm done with this for right now. But I found my way back recently. When I saw the movement for GME happening, I had been saying since the early 2000s that we needed to get rid of these hedge funds. I really felt it was a terrible idea that we could have outside sources from outside the country that could dictate how our markets operate and whether or not companies are successful. I saw that as like a huge danger to our economy, especially during the times when we were watching a lot of companies outside the United States that were coming into the United States and buying up American companies. You watched all kinds of like stadiums change their names from, I lived in San Diego at the time when I was younger, and it was Jack Murphy Stadium. And what is it now? It's like Qualcomm Stadium or something like that. That is actually a U.S. company, I believe. But you had all these different stadiums that were being bought up by these foreign entities, and I was just like, "Oh, these hedge funds are terrible." And so when this movement started happening, I was like, "Oh, I want to be a part of this." And so I did. I bought two shares. It was just two shares. It was the only money that I had liquid at the time that I could put into GME. And so I bought two shares of GME, and then I had another chunk that I was waiting for to settle, and once it settled, I was looking to invest the rest of that. It was like $3,000 or $4,000 into GME. But as I started doing some more DD and just in general, kind of looking at how things were happening, AMC seemed like a more viable option. I really felt like what they were trading at in price made it a much better outlook as to where they would end up after a squeeze, and I kind of wanted to help that movement, and so that's where I ended up putting the rest of my money from there on out. But yeah, I think a
Yeah,
lot of us are in the same boat. Um, but let's
yeah.
more importantly not just move away from me. Let's talk about you. What I really do want to see is I want to kind of cover some of the DD that you've got up. And the reason I want to cover that is I will post this really quick. This is just my simple ape smooth brain DD. And I don't know if you're watching the stream or not, but currently what I have up on the screen is a couple different indicators on the on loan average age per day that were flagged that I saw as in my line of work. I've always kind of looked at statistical process control, and it helps you to identify like trends. And I saw these trends and price increases from these trends over time. And there was one specific point where it didn't really match up, but all the rest of them did. And I felt like I could be seeing, especially on the last indicator, where we're currently at right now, that there was going to be a price increase coming. And then I saw your post. I'm gonna go ahead and share that on the live stream. This is True Demon's post right here. This chart right here is what really triggered me, because on this chart he has free float on loan and on loan average age with the failure to delivers, all on one page along with the price of the stocks. And he's got a lot of flags in here, and a lot of the flags that he pointed out were the same exact ones that I was seeing. And so I keyed in on that, and I was like, wait a minute, this is hugely important. So tell us a little bit about how you stumbled onto this. How did you first stumble on this?
So what what I started looking at was I was just digging through so many different trends with AMC stock because I like you, and you mentioned this before, but you saw AMC as the more viable play, which is exactly what happened to me. And I was like, this company's got a good long history ahead of it. If they come out of this, risk of bankruptcy, they'll be in good shape. They're going to do well. They will survive as long as they can get through this year. So I paid really close attention to the trend analysis and watching things develop. And funny enough, I don't have access to Ortex. I've been using all these friends from different communities who I have a huge, I have huge gratitude for. Um, but they've been feeding me all of this data, and every time I ask for something, they get so hyped because I start seeing all these different matching trend data. So what brought me to these different dips about average days on loan was because I was asked, like, how do you know if they're covering? And I was like, well, that's easy. You see a massive drop in the average days on loan
Bingo.
coinciding with a massive drop in shares on loan.
Yep.
It has to happen at the same time.
Hmm.
And it's an average formula. That's it.
Hmm.
But as I was drawing this chart to explain that to someone, I was like, wait a second. There's a relationship here with the price.
Hmm.
And I just saw it by mistake. It was entirely by accident, but I saw these dips here in the average days on loan, and I'm like, yeah, it's here. See, here's the dip on the loan, and then here's a rise in the shares on loan, or a dip in the average days on loan, rise in the shares on loan. You can see the spikes, and every time there's a spike, price gets hammered. That's we all know that. We should all be able to see those trends. Every time they short, the price goes down. But then I was noticing like there were interesting trends that coincided with the failures to deliver because as you see the sharp rise in loans, you see the failures to deliver do this parabolic arc
Hmm.
until it spikes. And the whole time, the shares on loan continued to rise all throughout that period. And they're still rising up until suddenly there are covering periods when the days on loan and the shares on loan drop at the same time. There's
Hmm.
only been two of those events.
Hmm.
So I was like, if this is all still going up and this is all still continuing to happen, even after what happened on June 3rd, then we are absolutely in for a far more monumental movement. And we are probably on the cusp of it. I just have to find some piece of data that is ahead of the failures to deliver because we can't see them until they already happen.
Right.
So I was looking for something to find a way to predict when the failures to deliver were going to explode.
We're on the same page. It's exactly how I felt.
Yeah.
Yeah. That's
Yeah.
awesome. Well, a great find on your part because I think you are 100% on track with what you're going to predict here. What I think the future has to hold for us. Can you describe the cycles in a smooth way, in a smooth way, in a way that my smooth brain, ape, can understand? So I've got your chart up here, and I want you to, if you can kind of briefly discuss your T21, T35, which I know is really your 15 and 6, 15 plus 6 days. Can you describe that process and how you kind of fell onto that and try and make that make sense to me?
Yeah. So, just for everybody, T is the date of the transaction plus the number of trading days. So it's not days, it's trading days,
Right.
days of the week. Um, so T settlement is what we refer to as the number of days that any given organization has to settle trades. Um, Currently, our trades work on a T2 settlement. That's we do the transaction and then the actual shares get delivered up to 2 days later. That's designed so that the broker has enough time to actually clear the trades. They send the trades to what are called clearing houses who hold the certificates digitally. And those clearing houses then place the ownership to that broker who then settles it into your account. And that's the T cycle. Different organizations have different T settlement cycles, which add up to certain points. So the popular one is T15 cycles for brokerages.
I'm just going to stop you
So
real
there's a
quick
T15.
because you have a
Yeah.
T21 on your page here, and then that's actually the
Yes.
T15.
Not quite.
No,
So it's a
okay,
combination. There's two T cycles that occur. There's the brokerage T cycle, which is they get 15 trading days in order to settle all their trades for the week when it comes to settling. I'm trying to remember. It does have to do with the shorts, but it's added onto the market makers T6 settlement dates.
okay,
Um, it all has to do with failures to deliver in the schedule for when they are delivered. When it comes to failures to deliver, the brokerage gets 15 days to settle those. Um, a failure to deliver, very simply for everybody, is when you are supposed to deliver a share. This is, say you sold a call option and that option went in the money. You get assigned and you are obligated to deliver the 100 shares for that call option to whoever bought it. Now, you get 15 days to settle that trade if it fails to deliver. And if after that point it still fails to deliver, then you lose your ability to short. Uh, you basically freeze trading for that organization on that stock. Then at that point, when the broker settles that, it goes to the market maker. The market maker gets T 6 days to settle a failure to deliver. And that is what adds up to the T21.
Okay, I
So
got you.
every time we go through a T21 cycle, you're completing a failure to, that is the full cycle of a failure to deliver before it goes to the clearinghouse. So when a market maker settles, or rather they fail to settle a failure to deliver, it goes to a T35 cycle,
Mm,
because the clearinghouse, they get 14 days. Why they get so much time is beyond me, but they get 14 days. I didn't truly understand this relationship because I didn't understand the mechanics of why there are so many, like, why are there so many handoffs in this process? And it all has to do with shorts and short exemptions and failures to deliver, all basically being a constant process of kicking the can down the
I love
road.
that term.
Yeah. I'll save that for later questions, because you're going to ask questions I'm sure that'll relate back to this. But after T21 goes up, then the market maker essentially has to deal with that failure to deliver. They don't get a choice. Um, they have to either buy or borrow, which was a key component of this. They have to buy or borrow shares in order to close that failure to deliver. In the case of naked shorts, however, the shares don't exist. And what I've discovered is that through a laundry list of conspiracies that you can relate to Atobit's House of Cards due diligence post, is that the DTCC, or the Depository Trust Clearing Corporation, who settles all major stock market trades and is the last stop for failures to deliver. And when a failure to deliver continues beyond that 21-day cycle, it ends on the T35. What I found, or what I suspect, and this cannot be proven because it's been buried in a litany of settlements with the SEC and regulations, and the Fed never wanted to touch it, and Congress didn't want to hear about it. Um, but they just disappear. And we don't know how. Nobody knows how. The failures to deliver just stop with the DTCC.
hmm
And that's and it is at that point that I came to understand that the DTCC either has some miraculous way of covering the position and acquiring the share from somewhere else and then paying out of their own pocket in order to settle it, and that's their role that they just accept as a ordinary risk of being the depository trust for digital shares, and that's the end of it. Or they are complicit in the fact that naked shorting is existing, that it continues to exist, that it has existed for decades, ever since digital trading became a thing and algorithmic trading has ever existed, and that when a failure to deliver finally comes to them, they just pull a share out of the ether, make it exist, and add it to the depository. And that is essentially the life cycle of the naked short.
Okay, that is really intense. So on this chart that I'm looking at here, we have the failure to delivers exponential growth prior to ripping, and so when you're talking about these failure to delivers, they exponentially keep going up, and we can see that we're on that trend right now. Your chart here does not show the most current failure to deliver, so I'm going to go ahead and post that up here real quick just so everybody can see it. But we did have the failure to delivers for the end of the month here. I'm going to go ahead and pull up the same indicators that you had on yours. Why do you use free float on loan versus on loan?
The reason why I do free float on loan is because it's a good indicator of it's a good indicator of movement in retail, because the total shares on loan will also include institutional shares. which those are being traded back and forth and cycling through repeatedly and over and over and over again. Free float on loan gives me a good idea of how many apes are actually mistakenly loaning out shares.
Ah,
And also, it's still a good metric anyway. Even though it's not the total amount on loan, we we can see how much of the free float is being traded. And I'm waiting for a day when the free float on loan exceeds the actual shares that exist at some point. It may never happen, and it's not required for the squeeze to occur, but if the free float on loan ever actually exceeded the free float issued, well, I'm I'm going to be watching, I'm going to be staring at my wrist, counting the seconds for the SEC to bust down Citadel's door.
well, we're looking at that last chunk of failure to delivers that happens to be the same chunk that put us on Reg Show. And I just call it Reg
Hmm.
Show for short. But that last chunk really kind of, when I saw that, I'll tell you what I was expecting to see before I saw this data pop up. The big, huge column um, of free flow on, sorry, not free flow on failures to deliver that we saw back in, when was this? January 27th. I expected to
Hmm.
see a massive column like that showing up in those June numbers that got posted, and it wasn't. To my surprise, it was over multiple days. It was 8 days in a row, if you count them, that those were all stacked on top of each other. And it started to get me to wonder: is this a cumulative number? Do you feel like this is a cumulative number, or do you think that this is a number that is like, so? For example, if I look back at June 21st, the value on the failure to delivers is 2.33 million, and then it jumps up to a bunch of days in a row where it's about 4 million per day. Is that per day that they're failing to deliver, or is that a cumulative number that you think is adding up over time?
No, that's so you'll hear people say it's cumulative, and that actually means your former description. The cumulative is like those are the current failures to deliver that exist on the stock.
On that day?
So every single day that on that day. So that is the total failures to deliver on that day. So
Right.
that is the definition of cumulative, even though it sounds counterintuitive.
It does. And it's been
Yeah,
confusing the
it,
crap
it
out of
it
me.
confused the hell out of me too. I was like, I thought these added up, but no, it's not the case. When you look at failures to deliver on the day, that's the total failures to deliver on the day, because failures to deliver don't go away until they are settled and closed.
So, what is the difference between the current swing and failure to delivers in the fact that there are multiple days of 4 million failure to delivered shares versus the time when we had that huge, just one candlestick, or I don't want to call it a candlestick, but a column of 27.6 million? Why are we seeing a difference? Why do you think or why do you hypothesize that there's a difference between multiple stacked days of failures to deliver in a row versus just one specific day of it?
Well, I have a suspicion, but I think it's a liquidity issue. And what I mean is, here's the thing about failures to deliver when it comes to a market maker. Market makers cannot hold failures to deliver longer than 6 days, because if they do, then they lose their ability to short. They get restricted by trading rules and regulations that prevent them from being able to trade the stock if the failures to deliver exceed a certain amount and continue past T plus six. Now, I have to explain market maker mechanics to make that kind of click. When a market maker takes a trade, remember, market makers they're handling trades in microseconds, and it's all happening automatically. And the way it works is the retail investor raises their hand and says, I want to buy this stock. This is what I'm offering. The market maker will instantly, in the fraction of a second, rip that money out of their hands and go, I will deliver you that share. And they put it in their account. The market maker then goes into the market and go finds a share to buy at a cheaper price. And then they buy it and deliver it to that customer. And they keep the difference, what we call the spread. So that's the difference between the bid and the ask. So whatever the spread is, that's what the market maker is profiting off of every single trade, millions of trades per second. Add it up over a day, and that's millions of dollars. So they are incentivized to have high volume, high trading frequency, and tons and tons and tons of shares going on. So there's an additional mechanic. When a market maker cannot find a buyer, then they are permitted to borrow the stock in order to deliver it. And that's what they frequently do. So when they need to deliver that share to that customer, they'll usually borrow it instead. So they take a short position on the other side of the trade. And then they'll go into the market, find it for a cheaper price in order to make a little more money off of the bid ask spread. So, in a situation where market makers are not able to short, that severely impacts their ability to complete trades. And if you take away their entire ability to short stock, then they lose their ability to make the market for that stock. And then trades freeze for it, unless they can go buy the stocks themselves. So that's a significant problem for them, and they can't allow that to happen. So that's why they're incentivized to take care of FTDs. So now I'm going to point something back out on this chart. Look at the FTD spikes. You'll notice that after the FTD spikes, they drop down off the face of the earth, and then there's a 6-day gap. There's a 6-day trading gap every single time. And then it spikes again, or it starts to rise again. That's because they're closing those failures to deliver, but they're allowed to close their failures to deliver by borrowing more stock, which they need to deliver within 6 days. So they kick the can down the road for 6 days.
Okay.
And then they go borrow another share. And then they do it again and again and again. And the FTDs start to climb, and it gets exponential as the volume continues to rise on the stock because they're still having to make the market. So now you can see that interesting trend. And now I'll go back to that big chunk where we went on the threshold securities list right there at the end of your chart.
Right.
So we were on the threshold securities list for a total of 12 days. The stock continued to go down, and we have our suspicions about who that was, but I suspect it wasn't market makers that were doing it, because if market makers were the ones holding those FTDs, then they wouldn't have been able to short the stock at all. Or if it was the market makers, then they were doing it illegally, because they can't do it while it's on the threshold security list because they have failures to deliver that should have expired past that T6 settlement.
Unless
So
is there
there's a lot of
is there an unless that comes in there if it goes on to SSR that they can?
well, that's where short exempts come in. And that's where it gets really interesting.
Okay.
So you might like to pull up the other chart that I did in Excel. I had to correlate all this data from Ortex, and I have to thank a gentleman named Vigilant Watch that pulls this data for me. But Vigilant Watch gave me all the Ortex data and pulled in the short exempt data, which you can pull off of FINRA's website every single day. So real quick, I know it's a really busy chart, but the blue bars are the new shorts or the new shares on loan. They're not necessarily sold short, but they're on loan. The yellows are the FTDs again, and then there's little black bars that are the short exempts. So short exempt is a situation where a market maker is allowed to short a stock without locating the share. Doesn't that sound familiar?
Yeah.
Yeah. So that's a naked short. We all know what naked shorts are. It's when you borrow a stock that you don't own, or when you short a stock that you don't borrow or can't buy yourself. The reason why this exists is because the market maker, in their efforts to be able to um, make the market, according to the SEC, is such a vital role in the health of the stock market that they get a special exception. We call this short exempt. The short exempts are very special. One, short exempts are allowed to occur during the uptick rule. So if someone's taking a buy, then the market maker is allowed to short during SSR without there being an uptick. So that allows them to take the other side of the trade, which is okay, fair enough. But a buy should be an uptick, right? Not necessarily. Not if the buy is being held on their books and then they settle that trade later in a dark pool. But let's just ignore that for now. The other part of short exempt, if you look at Reg Show, is that they don't have to locate the share at all. They get T plus 6 days again. So they don't have to locate a share for 6 days after they've taken a short exempt. So, well, holy cow. Now we have another trigger for that T plus 6. So basically, what a short exempt is, if they didn't locate the share, then it's a naked short. And what's worse is it's a naked short that they're allowed to pummel the stock with on SSR. Oh, but it gets worse. When the stock is on SSR, you'll notice that the short exempts skyrocket every single time. And it's because it's on SSR that they are put in a position where they must say, "Oh, we're the market maker and we have to make the market. And this stock's on SSR. But I have to take the other side of the trade. There's no stock to borrow because my partners over at Citadel Investments have borrowed they're holding all the loanable shares right now. So sorry, I can't borrow a share. I'm going to have to short exempt that." So they take the short exempt, but they don't fill the other side of the buy order right away. They just hand the share digitally back to the person, and then they settle the transaction off the exchange. So they hold that amount on their books. And this is speculation. This is all speculation at this point. But if they're holding that money on their books, then what they're basically doing is accumulating buy orders and putting them into blocks, settling them in the dark pool where they're not going to affect the price. And then the net effect of that is that you have a market maker that's shorting a stock with a short exempt, which is naked. They put that through the lit exchange, but then they accumulate all the buys that are coming in from retail investors, settle it in a dark pool where it doesn't touch the exchange and the price is unaffected. The only thing that happens is the price keeps going down
Mm.
because all the exchanges see and all the NBBO sees is the lowering bid. And there you go.
So while we're thinking that SSR is actually supposed to be helping us out, it's actually in the favor of the hedge funds.
That is what I suspect, because the SSR, by its nature, gives the market maker an excuse to say, I have to take a short exempt, which is basically a legal naked short if they want it to be. It doesn't have to be. They can choose to borrow the share from somewhere else and short it even during an uptick as a necessity to make the market, which that's fine. I could live with that. But if they're not locating the share, then it's a naked short and legal they're given a legal precedence
To
to
do
do it.
so, yeah. How many? This is a loaded question. How many naked shorts do you suspect are out there? It's such a loaded question. I know that it's almost
It
impossible to
is a
answer.
really hard thing to speculate on because there's no way for us to know how many of these short exempts are naked. We don't know how many of the shorts themselves are naked, and we have no idea how much of the volume that's being traded in dark pools and the ATS exchanges that aren't really accounted for. The only person in existence that can answer that question is the clearing corpse. It's up to the DTCC to answer that question. They know the answer to that because if there are naked shorts, they have to that's where they end. That's where those FTDs end. And if they end up creating a share in order to cover that deficit rather than pay to cover it and go find a share at the market price to close the FTD, which is their job as the clearing corp, then they're not even just complicit, they're colluding.
Hmm.
And that's also speculation. Hell, it might even be considered libel, but I really don't care. If somebody wants to come and sue me because I think that they're basically gaming the system, they're welcome to try. I want to know. I want to be sued for this so that I can have my lawyer prompt an investigation to come to the bottom of it.
Right.
Please, I invite it.
Yeah. Just want to point out that Teresa Torgerson is asking when will we squeeze, and I don't think that I don't know that this is necessarily a point that you want to say that I know when this is going to squeeze. It's coming up. I think you probably have a different message for that. What you're saying is
Yeah,
that there's an
I
indicator that would kind of point or lead us to point towards something to look forward to. Was that what you would say?
That is what I would say. So I don't know when the squeeze will happen. Nobody knows when the squeeze will happen. In fact, I don't even think the market makers themselves or whoever the hell is this short on AMC and GameStop that they're this desperate to hold off this coming tidal wave that's about ready to wipe them off the shores. But what I will say is that I see these indicators and I see these repeating trends. So I have three signals that I've been paying attention to.
Great. I was just going to lead into that. Here we go. This is good stuff. Here it comes.
Yeah.
Number one,
So yeah. So number one, and I have to pull it up because I want to make sure that they're in order.
utilization,
The
right?
first one is the average short exempt volume.
Oh, yes, 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 yes. That's right.
Yeah. So the triggers that I'm looking for is that the short exempt volume or the average short exempt volume will exceed 3 million on several consecutive trading days.
Okay,
This
where do we look
happened.
that up?
So you can look at that on FINRA's Reg Show database. That you can either you can go to my DD post and you can look at the link for the regshow.finra.org, which contains all the daily updated short Reg Show files, and that lists all of the short volume and the short exempt volume. It's a it's a raw text file and it's ugly to look at, and unless you're a programmer, it sucks.
Right.
So the other option that you have is to go look at Quandl, and that's also linked. So if you go back to my second part DD post, there is a link to Quandl, and you can I'll go ahead and drop it here in the Discord so you can put it
I've
in
got
the
it. I've got it
description of
up
this
here. Here.
video.
Oh yeah, absolutely.
All right.
Let me just go ahead and post that. I've got it here.
Okay.
Let's
So
see. Go ahead.
yeah. So this data will tell you where all the short volume is. So short volume and short exempt volume are different. Short exempts are part of the short volume, um, but it is not it's not total volume. And there's no you kind of have to if you know how to use a little bit of Excel, then you can draw an exact average. But what I'd say is look for the data to be very close to 3 million or above it. So if the short exempts stay above 3 million for several consecutive trading days, then that is an indicator that it's going to cause massive amounts of failures to deliver.
So as of
And it's
today,
going to
I'm sorry.
happen.
Let me just interrupt for just one second. As of the 22nd, I'm seeing a short volume of 16.9 million shares. Is that correct?
Yeah, that's the short volume, the short exempt volume. If you click on the green dot and then zoom in on the range,
The green dot.
yeah, upper left hand corner of the chart,
Oh, okay, got it. Okay,
you'll see short exempt volume.
right.
And then go ahead and zoom in on this range and bring it um, all down to the wire, and you'll be able to see it a lot more closely.
Okay, so it looks like for June 22nd, we have 808,000.
Okay.
Is that
So
right?
this is, yeah, that looks like, yeah, that looks right. So this data is not complete. Each of the trading facilities have their own. There's NASDAQ, there's NYSE, and there's Amex. Those are the three major exchanges. And the trading facilities don't all uniformly report their short exempts, but the short exempts on the NYSE are the big ones.
And it actually
So
shows
the
here
short,
latest volume values at the very bottom here. So if you don't want to zoom in on it, it probably shows that without actually having to look at it. But it shows short exempt volume at 808,248.
80824.
And
Yeah,
you
that
and
that doesn't.
you're saying it needs to be over 3 million.
Yeah.
Okay.
So I actually went and consolidated all the total short exempts. So again, this is a situation where the data is not complete. I'm going to keep updating my DD posts in order to keep everybody in the loop as much as possible.
Okay.
But I'll just let you know when I see the triggers.
Okay.
But the short exempt volume from yesterday was about 1.3 million,
Okay.
and then the day before that was 1.2 million. So we're kind of we're a little bit low, but it's a lot. Don't let that number fool you. That's a lot of short exempts for any stock. That's a massive amount of short exempts. If you look at the amount of short exempts on a stock in its history. Like just look at AMC. Its short exempts before December were never above like even 1% of its total short. And right at these numbers, it's averaging about 3% ever since January. And that's a very significant amount because a short exempt is by its nature an exemption. It's exempt, but it's a very rare exception for very rare circumstances where the market maker is not able to make the market under the current circumstances. And that puts them in a really tough spot. So when you see short exempts skyrocket the way they have on all of, GameStop and AMC, it's not normal. So the fact that they're staying this high is significant. And what you'll see is if these fail to deliver, they'll fail to deliver in 6 trading days.
Okay, well, I am going to be looking to you from now on then for consolidation of those values because it's something that I can't figure out on my own. It sounds like it's something that has to be compiled, and so I'm going to be leaning on you for the future.
All right.
No
All
pressure,
right. Yeah, I
no
know a lot
pressure
of
at all.
people. I know a lot of people are begging me for like the data to be updated. Like this was not easy to find, and it was not easy to consolidate. But I want to make sure it's there in front of everyone.
I think maybe
Okay,
what we
so
should do is reach out to Stonko Tracker, and I'd like to see them add that to the information that they're posting up there. If that means I have to donate to their cause, I think that information would be entirely valuable to us, and I do believe that they're posting information that they think is valuable. So I'll try to
yeah,
reach out to
I
them and
I
see if we
agree.
can make something like that happen. Maybe it'll save you some time. It'd be nice to see it just easily compiled into one spot.
Yeah, I agree. Stocko Tracker has been great, and I would love to be able to see that data in a much easier format than what I'm doing with it. Anyway, that was the first trigger. So I'll repeat it. The first trigger is average short exempt volume is over 3 million for 5 consecutive days. Even if you just go into that reg show file for that particular day, just do a control F search on the page for AMC and you'll find the total volume, short exempt volume. It's just a comma separated. The second trigger is short utilization over 95%. The last time I looked at the utilization, it was at 87%, which is really high still. That's still a hard to borrow stock, but it's not extremely hard to borrow. When a market maker is put in a situation where there are no shares to borrow, is when it's going to be hardest for them to deliver their shares because they can't kick the can down the road anymore without doing naked shorting and without buying. And if they continue naked shorting, well, it only takes a moment for them to get put on that situation where the FTDs prevent them from shorting. If they have to close the FTDs and they cannot short anymore, then that means that they have to buy. They don't have another choice.
Right.
And the third trigger is 2 to 3 days of consecutive 5% plus price increases. We're already doing fantastic. We're at 2 out of 3 days right now where the price is climbing. I mean, what is AMC even at right now at this very moment?
We're at
It's at
3708.
37.
Yeah.
So we're down on the day, but we're up overall from our position at the beginning of the week. So we're not quite there, but we're getting close.
Yeah.
So average short exempt volume is extremely high, over 3 million for several consecutive days. Short utilization is over 95%, and then 2 to 3 days of consecutive increases of the price. 5% or greater is what I'm looking for, but it may be much more than that.
Okay. One of the questions that I had was going back to that utilization and Ortex being a valid entity as far as how what they're reporting because they're only reporting what they're getting fed as information. How do we know if we're above 95% utilization if we can't trust Ortex data fully? Is
So that's a hard question. That's a very good question, and it's hard to answer. And I don't fault Ortex in the slightest
me
because they're
either.
getting the data that their brokers are giving them, and the brokers like I cannot definitively prove this, but they're not incentivized to be honest about it.
Hmm.
The brokers are in this situation with the hedge funds that have shorted the holy hell out of this thing. And it's the broker's fault. Okay. The hedge funds short the hell out of the stock, but the brokers are the ones who are not delivering. They're the ones who are not taking a borrow. They're the ones who have not located the shares. That's up to the broker. It's the broker's fault if they're not locating shares and they give the short to the hedge fund anyway, and they know it's a naked short. At that moment, the broker knows,
Hmm.
and the market makers know when they're taking a naked short. There's there's no way around that. But they will, in an effort, and I'll quote Jim Cramer: "When you're short a stock, you don't want to do anything remotely truthful because the truth is so against what you want to happen to the stock that I'm at this point paraphrasing because I can't remember exactly, but it's very simply you want to lie about everything because if the truth came out, then the stock would move against you. It would go up. You want it to go down, so you lie.
Yeah. I mean, you're not specifically pointing out anybody. I think you're only stating things that he's actually said himself. So I
Mm-hmm.
wouldn't worry about that at all. We all know where Kramer comes from and his background and the fraudulence that was in his history. So I mean, he's openly
Mm-hmm.
said it himself. Um,
I'll be very glad to see him prosecuted one day. Probably won't happen, but I'd love to see it.
at the very least, I'd like to see him testify, maybe on behalf of the retail investors. You know, as maybe some type of retribution for his past. I don't know. That would be kind of nice to see. Um, Let me see here. I have a couple questions, other questions here. This one's kind of a controversial question, and nobody's going to want to hear this. This is probably this is the point of the interview here where I'm going to ask you something that nobody wants to hear this. Nobody, but it's. I think it's just something. It's an interesting point that an exercise, a brain exercise that I had. But do you believe that shares are being lent, that they're coming from institutions that hold long positions, and what do you feel would be the objective of this? We're, I kind of wanted to say who do you think they're coming from, but I don't want you to specifically point out anybody because it's not really fair to say where those lent shares are coming from.
So
But
I
yeah,
do think that shares are being lent out from institutions, and they do it all the time. And why wouldn't they?
and
It's just like a stock lending program.
there's somebody who
They're
has a long
making money,
position.
yeah, from someone who has a long position.
Right.
Absolutely.
Yeah.
So it's the same with stock lending programs. When you're on, say, Webull, for instance, if you lend the stock, then you're obliged to a borrow fee. You get that fee, so you can profit off of a stock that you're long on, but you're not necessarily doing anything with.
Hmm.
And you can also play options like selling covered calls the same way. And I might love a stock. I might think that it's doing great, but I think it's going to go sideways, or I don't think it's going to do much. And I want to make some money while it's not doing much. So I'll sell a covered call or I'll lend the stock out. And that's how institutions think. I'm not lending out my stock. The reason, I don't want my shares to be used against me. But institutions don't think that way. They're thinking about their regular returns, their profit margins, and their customers. So they're obliged to get those returns any way that they possibly can. And lending stock is a great way for them to do that, especially in numbers of the millions of shares that they own, because they're also trading back and forth options. And they can
So
make a lot of money just on the volatility and just letting the shares sit in their account.
and this is
And
the
if
important part of your DD where you talk about how what we need to do as retail investors in order to minimize some of the share lending that's happening on our end, where they're using our shares to lend them out. Everybody needs to do their part in going on to their broker and making sure that their shares aren't being lending through that broker.
Yes, I that is extremely important. And it has a double effect. When you find, and any ape can have this happen to them, where they find out that their broker is lending their shares and they didn't know that, and that's fine. We there's a lot about this market and the finance industry that we don't understand, that we're only just now coming into. But when you find that you are allowing your stocks to be lent out, even if it's with your permission or you opted in by mistake, whatever, this is your chance to kick them in the teeth. Because when you revoke that option, when you revoke your share lending consent, you are forcing them to give your shares back immediately. and it has 2 days to settle, and then it becomes a failure to deliver, and the broker has to deal with that. So this is your chance to kick every single hedge fund in the teeth. If you go into your brokerage, go find out if you are in a stock lending program, go dig into it for yourself and really, really go find for sure. Check all your brokerages if you're in multiple and find how you can get out of that stock lending program or transfer your shares to a legitimate broker that doesn't do it without your consent. If you're in something like Cash App or Stash or something like that, you may very well be part of a stock lending program that you did not consent to because that is in their terms of service in certain brokers. Now, I don't know for certain which ones those are, but you have to look. And when you revoke that, or if you transfer your shares out of that brokerage, you are literally ripping the shares out of short's hands.
Yeah, that's huge. I have so many other questions here, and we're running out of time, unfortunately. But so let me just try to
I don't
move
mind
this.
going over if you want to get your questions out.
Do you believe that share? Let's see. I asked that question. So here's the second part to that question. If apes were to change their, this is the controversial part of that question. Just a brain exercise, so please bear with it. But if apes were to change their strategy, could we, in a sense, affect the strategy of those supply lines? So I like to think of it as like ammunition, right? Our shares that are being lent out, or brokers who are lending out shares to hedge funds to do all this nasty stuff to us. Um, that's ammunition. Is there a way to
Yes.
break those um, besides just stopping them from being able to lend our shares? Is there something else that we can do, or strategy that we can formulate as people in our long position to help screw them over even more?
What you can do, you know, this will require almost everybody that is in their current platform to get out and go to a different broker. So I don't expect everybody to do this. But the big thing that is going on is payment for order flow. Payment for order flow brokers, if you are not aware or you don't understand this term, is when a market maker pays a broker to send them their orders or route their orders through them. The reason that they do this is because the market maker, like I was talking about earlier, makes money on the spread of every transaction. They're incentivized to send as many orders to them as possible. It is a fact of the world that Citadel is the world's largest market maker, and every single broker works with them. There's no getting away from them. However, you can buy your orders through direct market orders. Direct market orders are when you select the exchange where your orders are bought through. So if you want to maintain or buy more long positions, you have to do direct market orders in order to make sure that your order is directed through the exchange directly. This will not only take away money out of the pockets of the market maker who would otherwise profit off of your transaction, it will also make sure that your buy affects the exchange price. And it's the exchange that dictates the price. This kind of goes into dark pool stuff, which I'm sure you're going to ask about. But when you are buying through a market maker, it's going through their books and they're transacting on their back end. It never sees the exchange unless they want it to. And for that reason, when you're buying through a payment for order flow platform, you are not affecting the price positively the same way that you would if you were buying directly from the exchange. I use Fidelity. I think that, and I was not on Fidelity up until just a few days ago. I transferred out of Webull and Robinhood, and it took 2 days to get my shares over. So it was no time at all. And the best part is if say the squeeze happened while I was in mid transfer and it was already happening, I can call my broker and I can say I have transfers in progress. I need to sell these positions. Can you do that for me? And they will tell you yes.
That's huge. Everybody who's listening to this needs to understand I'm calling it PFOF. I don't know what you're calling it. PFOF.
PFOF works.
Yeah, PFOF. So yeah, we need to get away from those as much as possible. Um, and selling directly to the market is by far the best way to go. If you're buying more shares, if you're holding and you have no more buying that you're going to be able to do from here on out, just making sure that your broker is not lending your shares is best. But if otherwise, other than that, just hold. That is it. but if you can move to a broker that won't lend out shares and also do your future purchases of shares through a system that trades directly to the market, that's the way to go. Absolutely. So speaking of dark pools, how do you specifically track dark pool percentage volume traded on each day? And do you agree with Stonko Tracker site data? Because I'll just say I'll throw it out there. I was looking at the data one day and I was trying to figure out like how they came up with, as an example, yesterday it was 71% traded in volume on the dark pools, and I was sitting there going like, how in the world is that possible? I couldn't come up
So
with that 71%.
yeah, so I will make an amendation for my DD post. The 71% doesn't just include dark pools; it includes not ATS or alternative trading system exchanges. So an ATS is not necessarily a dark pool, but it is an off exchange, like an OTC, over the counter market. So it does not necessarily affect the price as significantly as the the natural exchanges like the Nasdaq and the NYSE and the Amex.
Okay.
So, but that number, I posted a link in Discord for you to follow. I got this through Randall Cornett, who's another YouTuber that I've been collaborating with in order to find all of this data. He used Market Chameleon to come up with these figures. And with Market Chameleon, you can actually go dig into the daily transaction volume for any stock. You do have to pay for access, but that platform allows you to look at the individual transactions in dark pools, and they have access to all the major ones that I can think of, like with Merrill Lynch and Goldman Sachs, and I think the other one's called Instanet or something like that. Um, there's so many different dark pools, about like 30 of them out there currently. But yeah, the 71% was is a combined figure of ATS trading, which is market makers that have an ATS, and then there's dark pools, which is the private exchange between market makers, broker banks, hedge funds, and other major institutions, designed specifically so as to not affect the price in an unfavorable way to them.
Yeah,
And
absolutely.
I'll go a little bit further because I know you're going to ask about the 91% figure. That was a single transaction. That was a single period of the day where 91% of all volume on AMC was being traded in dark pool or ATS.
Okay. And so where are you seeing that data live? You're seeing it live someplace posted
Yeah, you can see that live
through
in
that
Market
link.
Chameleon.
Okay.
Yeah, I also use Unusual Whales because I like to trade options a lot, and it gives good alerts on options trading. But Unusual Whales also gives you dark pool uh, prints, so you can actually watch dark pool prints in real time.
Okay. And I went ahead and posted both of those in there up on the chat screen for anybody who wants to check those out. I will also probably edit the comment section of this as well later and post those as well in case anybody wants to see those. But leading into options, you did just mention options, and I kind of wanted to talk about that. Does buying options that fail to make it into the money help the hedge funds? I think it does. Am I incorrect
Yes.
in that?
Well, it specifically helps market makers the most,
Okay.
because market makers also make a market for the options trading environment. CBO or CBOE is I forget the acronym, but they're the major options trading market maker out there, out of Chicago. Um, and when they want to maintain a net neutral position, they don't want the stock to move at all. Ideally, it's like they're kind of stuck in a short straddle position at all times. But they're trying to make a market for options, so they're constantly buying and selling calls back and forth, but they're typically selling or writing the options in order to provide market liquidity. um, and that's how we end up with situations where we can buy like 100,000 options and get like tens of thousands of open interest on just one strike for a stock, and you get insane numbers like that. um, but yeah, to answer your question, when you see on Friday that the stock has been doing really well for the week, and then all of a sudden on Friday it gets its dookie pushed in.
Hmm.
It, it's the market maker. Like that's a market maker or a very large hedge fund that was short that stock, who sold covered calls in order to provide liquidity, and they don't want to deliver those shares. And especially in situation where there are not covered calls, but they are naked calls. And a naked call is very simply, it's a call that you write or sell, but you do not own the shares. And if you get into a situation where the price rapidly exceeds the strike price and they expire in the money, you are forced to deliver those shares, but you got to buy them at the current market price, which can be a massive loss. In theory, it's an unlimited loss because a stock can go from $1 to $40. And if you're not ready for that, if you don't have those shares, well, boy, huge, that's a huge loss.
So
And that's exactly what happened on in the first week of June, for that matter.
we've been tracking since I've been doing this show for about 3 weeks now. I'm tracking everything minute by minute for 9 hours a day. 5 days a week, and for the first time, I think it was might have been last week, and I don't remember what day it was. But we started to have, it might have been the 20th when we had that spike up in the price. We started to have an increase in price, and it was kind of like one of those spike ups where it was almost out of control.
Hmm.
And what happened was, is I watched the options clear, absolutely just clear from the options page, and
Hmm.
as they cleared from the options page, uh, it was right about the time that they cleared that it almost looked like it was a circuit breaker. That all of a sudden, instead of being an out of control raising price, it started to top off, and then kind of peak over and start to downtrend after that. And then after that point, the options started coming back, and they were repositioning into different locations. And I felt like and we've actually seen this occur several times. I want to post. It's going to be a video that I'm going to post. I'm trying to splice it up because I've been doing 9-hour chunks of video, but I'm trying to splice it up and post it because I really don't understand what's happening. But it really does look like every time we see the price start to get away from them, they all the options that are on there, like massive amounts. So you just see them completely disappear from the list, and
Yep.
and the price just stops going up. Do you know what's happening there? Is there something that
So
I'm missing?
so that's buying to close. So what a market maker can do is if they realize the price is about to get away from them, then they can buy back their option in order to close the position. So if they're sold short on an option, like they sell a covered call and they know that it's going to get away from them, then they can I'm sorry, they can buy that call from someone else and make it a net neutral position. And then they close out that option.
Okay, because
And
we're
that causes the open interest to go down. The volume goes up, but open interest goes down. So when
okay.
you see volume going up, open interest down, that means that market makers are closing their positions or people are selling. Right? People are selling their options in mass. And they're probably buying them from apes because people are taking profits when that's happening.
Hmm.
So that's a natural thing that happens in the options market, especially when you have a crazy run up like that. People are like, "Oh, this is great," and just take their profits at like 20 is a common one. Like 20%, that's a huge win in the options market, in a regular options market. But when you have a squeeze like this, I'm looking for 2,000 maybe.
Yeah. So that makes sense to me. I guess my question is then why how come we don't see the call options staying though? Because if they're going to run up to a certain amount, wouldn't it just be or wouldn't it just make sense to just buy back or buy back the put options and not the call options? Because if they're going to let it run up to a certain point, wouldn't it be best to try and collect even more money off the higher calls? Because they're hedging their
Well, the thing
bets.
is that they are making money because
Okay.
when you sell a covered call, you're collecting premium, and it's really really nice when. So this is a relationship in options called implied volatility. So when you look at that percentage there on the screen that shows like 100% or 200%, whatever,
Hmm.
that's implied volatility.
Okay.
The implied volatility is a metric that tells you um, it's it is that number made down to a decimal point. So 100% is one multiplied by vega, which is a Greek value for volatility. That is the amount added to the value of the option uh, per point of volatility.
Okay.
The easiest way to break it down is when volatility is really high, that's when you want to sell an option. When you sell an option during high volatility and then the price goes back down, or specifically a call option, let's just work with call options. Say the price spikes over to 70. You sell a call option at 70. The volatility is at like 500 or 600%. And you collect, we'll say, we'll say $50 premium, a $50 premium per option contract. So multiply that by 100 because options are levered by 100 shares.
Right.
That's 50 times 100. That's $50,000. So for every call you sell at that premium, that's $50,000. Then the price falls down to 60. When it falls, people start panicking and selling their call options in order to take their profits. And as a result of that, they are they're cashing out, but at the same time they're lowering volatility because the price is coming back down. So as that volatility lowers, we call that IV crush or implied volatility crush. When people buy a call option really high, when the price is skyrocketing, it feels good. But then all of a sudden the price goes down by $1 and suddenly the option goes down by 30% or something like that. That's not just the price working against you, that's volatility falling, and it happens fast. So when you see a stock going up really high and you're thinking about buying a call option because you want to chase that high, it's a really that's a pause moment. It's really dangerous because what you're doing is you are buying in at that volatility. And when it's really high, that option looks really expensive. But when the price plummets, if it goes against you, it goes against you fast. And I mean like by a lever of 5 times what it normally would in a normal market. So that's what the market maker is doing. When they see the stock skyrocket, they sell a call and then they dump stock and it forces the price down and it crushes volatility. And then people lose their ass.
Yeah. Um, how is it that the options can affect the stock in a way that it stops it from rising in price though?
So I don't think that that's necessarily related to options causing it to rise in. Or you're talking about the other side of the squeeze when it starts to fall.
Well, no, actually, because what we saw like this last, I think it was this last Monday. Actually, I think it even happened today. Today, let me look back at the history of today real quick here. This might be something you might want to watch from the video from earlier today. But we had a point at where it was earlier in the morning, kind of around the 9:44, probably Eastern Standard Time. The price started to peak up a little bit, and it ended up reaching up to close to $38. Right
Hmm.
about that point is when the options sold off, and
Yeah,
then almost immediately the price reversed and started going in the other direction. And so
yeah,
and this is like 4 or 5 times this week that I've seen this happen, and it makes it seem like the options are, when they sell off like that, it controls the price from continuing to reach into new levels because it really feels like we're starting to take off. There are these huge candlesticks that have, um, the volume really isn't any different during that period of time, but the price just seems to exponentially explode. And so
yeah. The price of option,
no, the price of the stock.
the price of the stock. Period. Okay.
Yeah, and
Um.
so these resets almost seem to have this effect of causing the price to fall, or at least peak out from where it's at.
Well, what I so there is some truth to what you're describing. Um. This is an effective delta hedging and unhedging. If you're not familiar with delta hedging, this is a concept of market makers accounting for risk in their options. So when a market maker sells a call, and they normally don't have a covered call. It's usually a naked call. So they don't have the stock. They don't have the underlying security to deliver if that option goes in the money. So when a price of stock goes up, especially close to its near expiration, the market maker does what they're called delta hedging because the delta of the option is the most important factor that dictates its value or its intrinsic value, we call it. So the higher the price is above the strike, or the closer it is to the strike, the higher the delta goes because that's the value of the premium of that option in relation to that price. So as that rises and it gets closer to the strike price, the in order to lower their delta risk, the the market maker buys stock. This causes a little bit of a bump up in the price, and then the price goes up a little more. So by actually delta hedging, the market makers are kind of actually working against themselves in a way. This is and if the effect becomes significant enough, you can actually get what's called a gamma squeeze. And that's what happened in June. That was a gamma squeeze. That wasn't shorts covering at all.
Mm.
In fact, the shorts on loan went up, but it was because of so many options. There was hundreds of thousands
I
of call
remember.
options on AMC that went from they were deep out the money at $40 and it just boom exploded in May, like right at the end of May. And then they increased the options chain out to like I think it was $140 or $145. And then people started buying all those calls. They sold all of their deep in the money calls, bought even farther out the money, and then the options chain went nuts. And
Yeah.
then the price kept going up. And then the market maker was like, well, shit.
Yeah.
Now we got to buy more stocks. So they had to. They had to
Right.
because the options were going to expire that Friday, and it sent it through the roof
Right.
on for the week expiring June 6th, I think it was. I think it was June 6th. So like it literally exploded that Monday.
Hmm.
So it just took off. So that gamma squeeze is Matt Kors. I follow Matt Kors' YouTube channel. I'm in his community and everything. But he made this analogy that stock price is an option open interest is like gasoline. It's an accelerant.
Hmm.
The stock price is the match, and the higher the stock price goes, the closer it gets to that gasoline. And eventually, if there's enough gasoline, there's a little gasoline, you get a pop, there's a
Mm.
little poof, and the price goes up and it goes straight back down. People cash out, they take their profits, price goes down. The market maker de-hedges. That means they sell back the security into the market. Price goes down. The options end up out of the money again, and well, anybody that was left there with that option is holding the bag. Sorry. But if you have a lot of gasoline, like you put gallons and gallons and gallons of gasoline into a giant bonfire of matchstick wood, and somebody just gets a match a little too close to it, it explodes like you saw on June 2nd.
Hmm. Well,
So,
let's hope we can get another one of those gamma squeezes going here, especially with everything, all the indicators that we're seeing right now, and the failure to delivers, and everything that we talked about today.
mhm.
Hopefully we can see that. And again, we're going to be watching average short exempt volume over 3 million over 5 consecutive days, short utilization over 95%, and 2 to 3 days of consecutive 5% price increase. Those are the things that we want to see that are going to kind of indicate the things that True Demon has pointed out in his DD. Uh, the other thing that I want to just touch on is he has very good information down here about what does this mean, what do we need to do going forward as far as key takeaways and what apes can do to help. And the number one is hold stronger than ever. Number two is to get off those PFOF or payment for order flow platforms. Disable stock lending in your brokerages and use direct market orders to the NYSE or the NASDAQ for all stock purchases, and then spread the word. This is going to be, it's going to be a difficult thing. I'm not going to lie. This is going to be difficult to try and get everybody to buy into because not everybody's this invested into this. But the more people that we can move towards doing these things, I 100% agree with what you're saying that we're really going to stick it to them. And going forward, I look forward to seeing more of your DD out there, and I'm going to definitely be pushing that people come and check it out what it is that you have to say because I think you're right on. Um, and I hope to speak to you again. Unfortunately, today I'm running out of time. I have to take my son to a doctor's appointment. Um,
I
but
understand.
yeah, life never ends. As much as
It certainly never does. I will at least I do want to answer this because I know a lot of people are very curious about it, and you held off asking because it's personal, and I appreciate it. But a lot of people wanted to know my positions. Um, I have a significant amount of AMC stock. I won't give that number, but I am playing close options. They're close to expiring. Um, this is not financial advice. This is not a recommendation. I cannot stress that enough. Please do not base this trade just based on what I'm doing. Please do your own due diligence. I swear, you have to decide for yourself. I don't know what I'm doing, okay? As much as I like to invest my time into researching this and trying to find the truth, I cannot stress enough that none of this is provable. This is all based on trend analysis. This is technical analysis. And as good as it can be sometimes, it can be so terrible on other days. So please be careful with this information. But I'm playing calls that are expiring on the first week of August, that's August 6th, and August 20th. I'm targeting strikes between $40 and $50. I believe that if there is enough options and stock excitement within this next week coming up that we may be able to establish another price of above 50. That's what I'm betting on.
Mhm.
And I think that the short interest is still high. I think the utilization is still high. And I think that we're going to see the short exempts start to skyrocket soon. That is what I am waiting for before I pour every last cent that I have to spare on this whole project. Um, but I am playing options that are expiring pretty soon. So when I look at these triggers, when they go, I'm looking for 14 to 30 days expiration, and I'm looking for deep out the money options. I consider deep out the money option anything over 20% of the current trading price. That's how I'm trading these options so that nobody has to ask, nobody's left in the dark about what I'm doing, but I'm not giving you a recommendation and I'm not telling you to start trading options, especially if you don't know what you're doing. They're so dangerous. I lost so much money in the first squeeze. Like, please don't do this if you don't know what you're doing. And please be careful.
Absolutely.
The best thing that you can do is just buy and hold, buy and hold. You
Yep.
don't have to do anything else because I'm not going anywhere. My stock isn't going anywhere. And there's millions of other apes who are not going anywhere. So, especially for the baby apes, all the newbies, we've been at this freaking war since January.
Yeah.
We're not leaving.
Not going anywhere. Not me. True Demon, thanks for being on here. Everybody, check out Randall Cornett. Tomorrow, you have a scheduled interview with him as well. I'm sure he's going to be able to touch on. Hopefully, he watches what's going on today and he has other questions for you as well. I know I'll be watching it because I won't be streaming because tomorrow we have a weekend. And I stress to everybody all the time: drink, eat, be healthy, have family time, and let your mind relax away from this. But in the meantime, we'll go ahead and let True Demon and Randall Cornett have at it and enjoy their show tomorrow for sure.
It's not set in stone, but I'll update this post if you're looking for that interview as soon as we establish a time. Thank you so
Awesome.
much. It was a real pleasure talking to you.
Yeah, it was a pleasure talking to you too. Okay, so I went ahead and ended the